What if I told you some of the wealthiest real estate investors in America pay almost nothing in taxes? And it's completely legal. Sounds crazy, right? But it's true. And the secret weapon they're using? Depreciation. When I bought my first rental house about 15 years ago, I was shocked when my accountant showed me how I could save over $5,000 in taxes just that first year. All from a 2-unit, 2-bedroom, 1-bath, upstairs, downstairs home. That's when I realized this depreciation is a fancy word that means some serious tax savings. And just the other day, I was grabbing a slice of pizza at my buddy Dan's place. Some of you might remember him from my other videos. He owns those Italian restaurants in my hometown. Anyway, he walks in, goes behind the bar, just as I'm about to take a bite, and he says, "Rich, this is my best year ever with these restaurants, but I'm gonna owe a fortune in taxes." Now, we're always talking business, so I just smile and I go, "Dan, you ever thought about buying another rental property?" Now, where my head's going is Dan's got older kids, he's got nephews, they're in their 20s, and he's got a ton of family, locally. So I'm thinking if he buys some real estate, and even if he's just renting it out to family or friends, then that could basically give him that depreciation he might need to essentially wipe out some of that taxable income. Now, he just gives me this look like I'm speaking another language right now, and I'm sure his mind is on his business. So he's probably thinking, depreciation, isn't that the stuff that, is just for losing value over time? And I get it. Most people think depreciation is a bad thing, right? Your car depreciates over time. Your phone, it depreciates. But in real estate, it's literally one of the most powerful tax advantages you can get. And here's the urgent part. Bonus depreciation is phasing out fast. Really, by the end of this year, that percentage drops. So this information could literally save you thousands of dollars if you act now. That's why today I'm breaking down exactly how depreciation works, showing you 2 amazing strategies to save thousands of dollars, and warning you about one mistake that could cost you big if you're not careful. Oh, and stick around because I'll show you the exact cost segregation strategy, and that's just a fancy word of saying breaking your property into smaller parts for bigger tax breaks, and how that strategy saved me over $10,000 in taxes last year on my rental properties. These are the legal rules, completely above board. Oh, and I've put together a free guide too that I'll tell you more about later, so let's dive right in. Okay, let's keep this super simple. Depreciation is basically the IRS letting you pretend your property is wearing out and losing value every single year, even when we all know real estate actually has been going up in price. It's like getting a tax deduction for wear and tear that might happen, or better yet, might not even be happening. Pretty sweet deal, right? Here's how it works in real life with a regular residential rental. For a $320,000 rental house, you have a cost segregation study done as soon as you purchase the property. Now, you need to work with a tax professional, and there is usually a cost involved too, but it's almost always worth every single penny. So in this example, the study found that about $95,000 of the property value was in those smaller parts, the components. And those could be depreciated much faster, the things like I mentioned, HVAC, flooring, appliances, the landscaping. So instead of deducting around $11,600 per year, you're able to deduct an extra $19,000 per year for the first 5 years. That's a total of over $30,000 in annual deductions just from one property. And Dan could do something similar with his restaurant real estate. Getting a cost segregation study for his commercial buildings, Dan could depreciate over $100,000 worth of his business stuff, the kitchen equipment, lighting, flooring, HVAC, and that's all over just those 5 years. So for a guy like him, that's at least an extra $20,000 per year in tax write-offs on top of his standard depreciation. And in his tax bracket, that's going to save him tens of thousands of dollars every single year. I even told Dan, it's like telling the IRS, hey, keep that tax bill, I'm good. Now, here's where it gets really interesting and why you need to pay attention right now. Bonus depreciation. This is a special rule on the books that lets you deduct 100% of certain expenses in the very first year. But here's the extremely urgent part. it's being phased out fast with specific deadlines. Yeah, so December 31st this year, that percentage you can deduct is scheduled to drop. And unless the rules change, it keeps going down until it's completely gone. So if you buy a $50,000 HVAC system for your rental property this year, you could potentially deduct the majority of it, say $30,000 immediately. But based on those current rules, if you wait till next year, maybe you can only deduct $20,000. And the year after that, only $10,000 will be allowed. So if you've got major property improvements or purchases coming up, or you're thinking about buying a rental property, you need to act now to help maximize these tax deductions. This time-sensitive information is exactly what I cover in detail in my free guide that you can download right now. Link down below in the description. All right, so what's the catch, right? Because there's always a catch. Well, that's called depreciation recapture tax, which is just a fancy way of saying when you eventually sell your property, the IRS wants back some of those tax benefits. Think of it like the IRS saying, you got tax breaks all these years. Now we want our share when you sell the property. Let me break this down super simple with one of my rental properties. If I've claimed over the years $100,000 in depreciation on my rental house, and then I go to sell it. After that sale, I might owe up to $25,000 in recapture tax. Yeah, that's right. They'll tax your depreciation deductions up to 25%. And I can already hear some of you saying, well then, what's the point, Rich? But don't worry, I got you. Because here's where it gets interesting. There's a completely legal way around all of this, and it's called a 1031 exchange. Basically, you sell one rental property, buy another similar or larger one, and you can defer those taxes potentially forever. This is how you grow your real estate portfolio over the years without paying these recapture taxes. Yes, it's completely legal. It's right there in the tax code, section 1031. And that's the playbook. That's how regular people use depreciation to pay little or sometimes absolutely nothing in taxes. Starting off, you got standard depreciation to reduce income. That works on your first rental house. Up next, you've got cost segregation to accelerate those deductions. And that works on smaller and larger properties. And then you got bonus depreciation while it's still available. And like I mentioned, 1031 exchanges to avoid recapture tax when you sell. And no, you absolutely don't need to be some real estate tycoon with 100 properties to use these strategies. Even one single family rental property can save you thousands in taxes. I mean, I started with just one property. We all do. Do me a quick favor. If this video helped you understand depreciation better, hit that like button. And if someone you know could benefit from this information, share it with them. Right now, pick up your phone, text them the link, and they'll probably thank you come tax time. Drop a comment below too. I honestly read every single one. Have you used any of these strategies before, or was this new to you? Oh, and I put together that free guide on the top real estate, tax hacks that most investors miss, including some of those deadlines for bonus depreciation. Click the link in the description to download it right now before you forget.